Welcome back to the Deep Dive. We're here to break down the dense data from your sources and give you insights you can actually use.
Yep, and today we're diving into American Superconductor Corporation ticker AMSC.
A name that's definitely been lighting up the charts. Talk about excitement.
Oh, yeah. If you've glanced at it, you know it's been explosive up, 185% over the past year? Something like that.
Incredible numbers, but it hasn't exactly been a smooth climb, has it?
Not at all. A lot of volatility. That's why we're here. It's a growth story, sure, but with some serious white-knuckle moments.
Right. So our mission today is really to cut through all that noise. We need to understand what's fundamentally driving this thing.
Exactly. We're looking at the financials, of course, but also this huge institutional buying and, well, how U.S. policy plays into it all.
We want to figure out how AMSC went from, frankly, consistent losses to suddenly being profitable, and why its valuation has soared.
And we'll try to simplify the tech side, the power electronics, the grid stuff, because their core technology is suddenly vital, not just for defense, but for AI, which is everywhere.
Yeah, it feels like it's become this key strategic piece, especially with the focus on domestic manufacturing and resilience.
That's the angle, and it helps explain why, 427 major institutions are suddenly placing big bets on what's still technically a mid-cap company.
Okay, let's build this from the ground up. Talk about the foundation that Q1 momentum, fiscal year 2025, announced back in July.
Right. That quarter was pretty stunning, a record breaker for them.
What did the numbers look like?
So record revenue, $72.4 million. That's an 80% jump compared to the same quarter last year. 80%.
Wow. Okay. And the bottom line, profitability.
That was the real kicker. Net income came in at $6.7 million. And crucially, that made it their fourth straight profitable quarter.
Ah, so that's the inflection point investors look for, moving from maybe profitable to consistently profitable.
Exactly. It signals that maybe the business model is really working sustainably now.
And we saw improvements in efficiency, too. The growth margins looked better.
They did. Margins hit 34%, up from 30% the year before. That's partly better operations, but also integrating that NWL Inc. acquisition.
Right, the NWL deal. How strategic was that, really?
Oh, very. NWL wasn't just any defense supplier. They brought specific expertise in maritime defense systems. Think advanced power systems for warships.
Okay, so that directly connects to some big contracts.
Correctly. It likely played a huge part in them landing that $75 million multi-year deal with the Royal Canadian Navy for ship protection systems. They essentially bought the expertise and a path to long-term government revenue.
That makes a lot of sense. Okay, so Q1 was great. Profitability is there. What keeps the momentum going forward is their visibility.
It is. They reported a record backlog, $127 million worth of orders.
$127 million.
Okay. And that's up 25% year over year. So that backlog, it acts like a near-term revenue guarantee, provides stability.
And where's the growth primarily coming from within that backlog? The sources highlighted the grid segment.
Yeah, the grid segment is really the star right now. Huge organic growth there, up 86% year over year.
86%. Okay.
And this ties right into those huge macro trends we keep hearing about.
You mean AI data centers and the new chip plants, the CHIPS Act stuff?
Exactly. Those are the big drivers for the grid segment.
Okay, hold on. We hear constantly that AI and chip fabs need tons of power. But why AMSC specifically? What's so special about their tech, like DVAR?
Right, DVAR. Think of it like a super sophisticated shock absorber for the electrical grid.
Okay.
These massive data centers, and especially chip fabs making tiny circuits, they are incredibly sensitive to power quality. Even a tiny flicker, a voltage sag lasting milliseconds, can ruin millions in product or damage equipment.
Ah, so DVAR smooths out those bumps.
Precisely. Dynamic VAR compensation, it ensures ultra-stable, clean power. It's basically an insurance policy against those tiny grid imperfections. For these advanced manufacturing sites, that kind of reliability isn't a nice-to-have. It's absolutely essential.
Got it. So they're not just selling components. They're selling critical stability needed by these booming high-tech industries.
You've got it. And that value proposition, that strategic niche, is a big part of what the market seems to be rewarding right now.
Okay, so that explains the momentum. Let's look at the immediate future then. What are the expectations for Q2? Their second quarter for fiscal 25, results probably due late October, early November.
Well, the company itself put out guidance, and typically, after a blowout quarter like Q1, companies often guide a little conservatively.
Standard practice, yeah. Manage expectations.
Right. So, official guidance for Q2 revenue is between $65 million dollars and $70 million.
Okay, so slightly down from Q1's record,
Yeah.
but still strong year over year, presumably.
Exactly. And they're still guiding for profitability. A non-JAP net benefit over $6 million. That works out to roughly 0 and 14 cents per share.
14 cents per share profit expected by the company. What are the analysts saying? The consensus view.
Interestingly, the analyst consensus from the 11 firms covering AMSC is actually a tiny bit higher. They're expecting, on average, below 15 cents per share.
So the market thinks they might slightly outperform their own guidance.
Seems that way, just a penny higher, but it shows continued bullishness from the street.
And zooming out a bit, for the full fiscal year 2025, are analysts expecting this kind of, well, hyper-growth to keep going?
Oh, absolutely. The full year projections are very optimistic. They see revenues landing somewhere between $250 million and $270 million.
Oh, okay. That's a big jump from where they were. What kind of year-over-year growth is that?
That represents about a 44.7% increase year over year. Massive acceleration.
Okay, 45% growth roughly. That definitely justifies the buy ratings we're seeing.
It does. The consensus among those 11 analysts remains a buy, and the average price target is around $64.
Compared to the recent price around, what, $58, $59?
Yeah, $58.57 recently. So analysts see more upside, likely driven by that scalability in grid and defense.
Which brings us nicely to the market side of things, the big money.
Right. When a smaller company starts showing this kind of growth and profitability shift, the institutions take notice.
And notice they have. This is where it gets really interesting for me, the institutional ownership. You mentioned 427 institutions.
Yeah, 427 distinct funds or institutions holding the stock as of August 2025. That's high visibility for a company this size, market cap around $2.65 billion.
And the total ownership percentage.
Get this, a whopping 70% of the company's capital is held by these institutions.
70%.
Yeah, that's 40.4 million shares out of about 45 million total. Big names are in there too, like BlackRock, holding nearly 7%, Bailey Gifford. It reflects a very strong fund sentiment score, suggesting active accumulation.
Okay, 70% institutional ownership. That sounds like a massive vote of confidence, right? Like it provides a stable floor because these guys tend to hold longer term.
That's one way to look at it. The optimistic view?
But there's a but.
There's always a but, isn't there? Especially with volatile stocks. We know AMSC has high volatility. The sources mention a beta of 2.1.
Right, beta of 2.1, meaning it tends to move about twice as much as the overall market, roughly speaking.
Exactly. So the big question becomes, does that huge 70% institutional block actually stabilize the price during shocks, or does it concentrate the risk?
Meaning if something goes wrong and these big funds decide to sell.
It could turn into a stampede for the exit. That massive ownership could amplify the downside, not cushion it.
It's a double-edged sword then. They fuel the rally on the way up.
But can accelerate the drop if sentiment turns. It makes the stock very sensitive to news and meeting expectations.
Which probably helps explain the valuation metrics. The price-to-earnings ratio looks really high.
It is. The trailing PE ratio mentioned was 148.32.
148. Okay, for listeners, unpack that. What does a PE that high actually signal?
It signals that investors aren't paying for the current earnings, that $6.7 million profit in Q1. They're paying for enormous growth expectations, potentially years, maybe even decades, of future growth baked into the price today.
So the valuation is pricing in near perfection.
Essentially, yes. And when expectations are that high, any small stumble, a contract delay, a slight miss on quarterly guidance can be punished severely by the market. That explains the high beta. The margin for error is just razor thin.
Speaking of market reactions and potential shocks, let's talk about the stock dilution back in June 2025. That often spooks investors.
It definitely did. AMSC announced they were offering 4.1 million new shares to raise about $115 million.
And the market reaction.
Immediate and negative. The stock dropped 13.2% in a single day, a pretty significant hit.
So why did they do it, raise the cash? And was that market reaction justified?
They stated the cash was for working capital and potential future acquisitions, basically. Fuel for the high growth they anticipate.
Okay, funding growth.
Right. And arguably, the market overreacted. Because look at the upside. That $115 million significantly strengthened their balance sheet.
Yeah.
As of June 30th, they had $333.1 million in equity and virtually zero debt.
Ah, so they used the high stock price to build a war chest and secure their financial footing.
Exactly, a smart strategic move, even if it caused short-term pain. And the strong revenue growth since then seems to have absorbed that dilution shock pretty quickly.
Okay. Looking ahead again, is there anything else on the market side, maybe a technical factor, that could influence the stock?
There is one potential catalyst: index inclusion.
Ah, getting added to something like the Russell indices.
Precisely. Based on its current market cap, AMSC is now eligible for inclusion in either the Russell 2000 or the broader Russell 3000 index.
And remind us why that matters for the stock price.
Well, the big index reconstitution happens annually, usually in June. So June 2026 is the next window.
Right.
When a stock gets added, all the passive index funds and ETFs that track that index have to buy the stock to match the index weighting.
Forced buying, essentially.
Right. Trillions of dollars track these indices. Historically, that force and inflow tends to give the newly added stock a short-term price boost, often somewhere in the 5% to 10% range. It's a known phenomenon.
Interesting. Okay, let's pivot to the bigger picture, the macro environment. Policy. We've established AMSC is tied into U.S. defense and energy infrastructure. How do political winds and trade policies affect them? Particularly thinking about potential policies favoring defense spending and tariffs.
We need to look at this neutrally, of course, just report what the sources suggest. And overall, the current policy direction seems quite favorable for AMSC.
How so?
While any policies that prioritize higher military budgets, especially for the Navy and advanced shipbuilding, directly benefit AMSC's Maritime Defense Systems segment. That's a clear alignment.
Okay, defense spending is a plus. What else?
Domestic energy resilience. Initiatives aimed at strengthening the U.S. grid, making it more stable for critical infrastructure that plays right into their grid segment, especially for those chip plants and data centers needing that DVR stability.
So things like the CHIAPS Act are essentially creating customers for them.
In a way, yes. Government investment in domestic high-tech manufacturing is creating demand for the stable power infrastructure AMSC provides. It's a significant tailwind.
And then there are the tariffs, that whole push for reshoring manufacturing. Tariffs on steel, aluminum, semiconductors. How does that play out for a U.S. manufacturer like AMSC? They operate in Massachusetts and Pennsylvania, right?
Right. And generally, tariffs designed to encourage domestic production help companies like AMSC. They make imported competing goods more expensive.
So it helps level the playing field or even tilts it in their favor.
It seems so. We even have the CEO, Daniel McGaughan, quoted saying tariffs have helped the level of reshoring that we see. It suggests a direct positive impact on their domestic order book and that record backlog.
Okay, so tariffs sound like a net positive, but are there potential downsides, risks?
There always are with tariffs. It's not simple. One risk is on the cost side.
Their own costs.
Yeah. While tariffs might block foreign competitors, AMSC might still need to import certain components themselves, think exotic metals or specialized parts for superconductors. If tariffs hit those inputs, it could squeeze their margins, that 34% we talked about, unless they can pass the higher costs fully on to customers.
Right, cost erosion. What about the global picture?
The other risk is retaliation. If the U.S. imposes tariffs, other countries, say China, for example, might impose counter tariffs.
And that could hurt AMSC's exports.
Potentially, yes. Specifically, their WindTech segment, which sells wind turbine components globally. That segment still makes up a decent chunk of revenue, maybe 20–30%. So while domestic grid and defense might boom under current policies, the export-oriented wind segment faces some trade risk if tensions escalate.
Okay, that makes sense. There are nuances there. So let's try to wrap this up. What are the key takeaways for the listener trying to make sense of AMSC?
Well, it seems clear AMSC is benefiting from several powerful trends converging: increased defense spending, the absolute necessity of grid stability for AI and chips, and the push for reshoring boosting domestic manufacturers.
And these trends are fueling that impressive revenue growth and giving analysts confidence to set those high price targets.
Exactly. But, and it's a big but, you have to remember the context, this is a high-growth stock priced for immense future success.
Right, that PE ratio of 148 tells you the market expects perfection.
It does, and the high beta of 2.1 means you absolutely must be prepared for significant price swings, both up and down. The volatility is inherent in this kind of growth story right now.
The story is definitely compelling, but the ride won't be smooth.
Definitely not. So thinking about all this, AMSC's critical role in U.S. infrastructure, its high growth, its volatility, and that huge institutional ownership.
Yeah, that's 70% held by just 427 funds.
It leaves us with a final thought for you, the listener, to consider. How much protection does that massive institutional backing really offer against major shocks? Does it create a stable base, or does that concentration actually amplify the risk, making any potential sell-off much faster and more severe? Something to mull over.